6 years after the global financial crisis erupted, the world is still recovering from the economic aftershocks. A storied investment bank with 80 years of history, Morgan Stanley came out of the financial tempest stronger than ever. A new business model has brought stability to the firm and positioned it well for future growth. Join us this week as I sit down with James Gorman, Chairman and CEO of Morgan Stanley, to get his take on the global economy, China, and the future of Morgan Stanley. Only on Biz Talk. A native of Australia, James Gorman's banking industry career began when he joined Merrill Lynch in 1999 as the firm's chief marketing officer after leaving McKinsey & Company as a senior partner. The next stop in his career took him to Morgan Stanley in 2006 as president and chief operating officer of the Global Wealth Management Group. As co-president of Morgan Stanley during the depths of the global financial crisis, James Gorman played a pivotal role in steering the bank into smoother waters. He became CEO of Morgan Stanley in 2010 and has been also serving as its chairman since 2012. So first off, James, thank you very much for joining us today. And before we begin, congratulations on Morgan Stanley's 20 years here in China.
Thank you.
The firm has definitely been critical to the opening up of China and the reform process. So we certainly hope a lot more 20 years down the road.
Yeah, so do we. It's been a very proud history.
Yep.
We started, as you said, 20 years ago with 12 employees in China. We now have over 1,000 employees.
Wow. Here on the Chinese mainland.
Yeah, on Chinese mainland, plus many others who serve Chinese businesses from around the world.
Excellent. Excellent. All right, down to business. Let's talk about your business model first. And ever since you took the helm in 2010, we saw this revamp of the Morgan Stanley business model. Talk to us about that. 5.5 years after the depths of the global financial crisis, how's everything working out?
I think if you go back in history a little bit, in 1997, Morgan Stanley, a very strong institutional business, merged with Dean Witter, a retail brokerage business with a credit card, Discover credit card. And for a long period of time, it effectively ran as two separate companies. Eventually, Discover Card was sold off. So we had a small retail business with a very powerful global investment bank. And one of the things we tried to do after the financial crisis was to find ways to provide more stability to the firm. And the obvious way to do that was to grow the private bank or the wealth management business, which is why we acquired Smith Barney from Citigroup. So now the firm hasn't shrunk the traditional investment banking business, the M&A advisory IPO business, has not shrunk that. We've just added a very strong and stable wealth management business. So the firm is more in balance than what it was. We're the number one equity capital markets player in the world. We're number 1 or 2 M&A in the world, number 1 or 2 investment bank in the world. So we have incredibly strong investment banking. None of that has changed. All we've done is added the stability that you get from a very large wealth management. Now we're the number 1 or 2 wealth manager in the world. So it's actually a very potent combination.
So the Smith Barney integration, that's gone very well. You're very satisfied with the Smith Barney integration?
Honestly, the first year was difficult. We had some systems issues as we tried to take 42,000 people and merge them onto one system. It was the largest acquisition in wealth management anywhere in the world in history, and the largest integration in history. So it took a little longer. We had a few technical issues along the way. Nothing consequential, Michael, more technical issues, but took a little longer. But once it was complete and done, it's fabulous. And now it's completely integrated, very stable, and a terrific business.
Okay. Now, when I think about consistent returns and stability, that really does sort of conjure up maybe, does it come at the expense of growth is what I'm wondering. So you have more stability, does that mean less growth, and perhaps how do you balance the two?
Well, again, what we did, we really have two parts to our firm. One, which I consider, if you think about it as a boat, the wealth management and asset management businesses are the ballast. They give us stability in the water. The M&A, the financial acquisitions, advisory, IPO business is what gives us the speed. So it's the speed plus stability is the Morgan Stanley model. It doesn't come at the expense of growth at all. We have actually great growth in wealth management and in the institutional business, but we have more stability now.
All right. Let's assume in the next few years that we see a pretty strong global recovery in the United States as well. Do you foresee that potentially banks will lever up again, financial institutions in general, maybe not as excessively as pre-crisis, but lever up to a certain degree, seeking products with maybe higher returns, higher risk? And What might that do to your consistent model?
I think that's unlikely. I think there are a lot of lessons learned from the financial crisis, and where the bank system now is levered approximately 10 times their capital on their balance sheet, some are a little more, some are a little less, is much more prudent. During the financial crisis, they got to between 30 and 60 times levered. That was obviously inappropriate and caused the kinds of liquidity issues and capital issues that the banks had. So I think that's very unlikely. You can grow strongly with the economy growing without improving the leverage because you're retaining earnings and growing your capital base.
So what if then, let's just assume some of your peers find ways to invest in more higher risk products, a little bit less transparent, more illiquid, but their shareholders are maybe happy because they have a high ROE. If that's the case, do you think Morgan Stanley will stay committed to this consistent return model still, if so many of your peers are doing it and earning high returns on it?
Well, there are a couple of big assumptions in there, Michael. One is that so many of our peers would do that, which I think in the new regulatory world is highly, highly unlikely. Number two, that they'd earn outsized returns on it, and I think that's near impossible because to grow those businesses and take on more risk, they're required to take on more capital, and by having more capital, you therefore reduce your ROE. So no, Morgan Stanley we're very clear about what we want to be. And we're very comfortable with what we want to be. There will always be somebody else trying to do something different, trying to create a new mousetrap, but that ends in tears. That's been the experience of the financial crisis. Be true to what you're good at. Be true to your own business model. Don't be distracted by other people promising outsized returns, which over time it proves those outside returns don't consistently deliver.
Earnings. Let's talk about your earnings. Q3 earnings, Morgan Stanley definitely beat it out of the ballpark, easily beating your immediate peers as well as analyst estimates. Q3 bottom line up 87% year on year, very spectacular. Question is, how sustainable are those earnings given where we are in the global economy right now?
Honestly, I don't pay much attention to quarterly earnings because they have a remarkable habit of coming around every 13 weeks. Okay. So they're pretty exactly. We're well under Q4, and any quarter's earnings are driven in part by the local market environment. And the local market environment in October was very difficult for the trading businesses across Wall Street, as it was, I think, in August. So they can be choppy up or down. But what we've tried to do is create a model that is stable in all market environments. It doesn't mean, some quarters will be better than other quarters. I'm less focused on that, honestly, than I am about how we're doing overall strategically and how we do on an annual basis.
Okay, but your top line right now, at least for Q3, 50% of revenues coming from still the institutional security side, 40% from wealth management. Is that sort of the optimal mix that you're looking for in terms of this balance that you're talking about?
It feels about right. About half the firm from wealth and asset management and half the firm from institutional securities. That feels like the model that serves Morgan Stanley shareholders best.
Over half a decade have passed since the Great Recession, but Main Street is still wary of Wall Street. Even though financial institutions are the backbone of any economy, Wall Street's reputation suffered a big blow as U.S. lawmakers had to muster taxpayer support to prop up the financial services industry. A survey conducted by PR and communications firm Makovsky in May this year showed that more than 80% of communications, marketing, and investor relations managers at financial institutions believe the financial crisis continues to have negative impacts on their companies. Morgan Stanley, though, is doing its part to bridge that gap of understanding between Wall Street and Main Street. Well, I want to first talk about this relationship between Wall Street and Main Street. Obviously, still 5.5 years later since the depths hit the U.S., there is, I believe, still a sense of perhaps distrust of Main Street to Wall Street. Do you see that gap sort of bridging down anytime soon?
It's a great question. I think, unfortunately, when you have any crisis of the magnitude of the financial crisis we had, and at the center of that was some banks, and at the center of that was some very bad behavior by certain banks, that brings the whole industry down. And it takes time to recover from that. It takes, the financial institutions have to be known to be financially stable so that they're not dependent upon being bailed out by their governments. And a lot of the capital rules and other changes have put the financial institutions in that shape. And most importantly, the financial institutions and their employees have to behave responsibly. We're part of the same ecosystem everybody else is. We don't operate in isolation. We serve our governments, we serve our corporations, we serve individuals. We need to be responsible in order to build public trust and confidence.
And the financial institutions in the U.S. right now are pretty strong.
Financial institutions are very strong in the U.S. They've recapitalized. Financially, they're very strong. I think they've improved their business models by de-risking, and I think they're slowly building trust and confidence. Of course, all of that only works if the individual citizen out there feels their lives also improving.
Right.
And I think unemployment coming down in the U.S., as an example, is a very important, necessary condition for building public trust and confidence in the financial system.
Do you think that regulators overall have significantly lowered the probability of a repeat of 08 and 09? It seems like from your previous answer that's pretty much true, at least in the near term, in the next 20, 30 years.
Yeah, I think regulators have dramatically lowered the kind of risk of the kind of crisis we went through. I mean, the banking system globally, the largest 27 banks, I think, have raised over $500 billion of capital and $1.4 trillion of debt. They're not comparable. Morgan Stanley had $30 billion of capital. We now have $67 billion of capital. We had a balance sheet which was 1/3 bigger than it is today. We had leverage that was almost 3 times what it is today. We had businesses that were pure proprietary trading businesses that we've closed and shut and sold. So Morgan Stanley is a very different institution, and we're emblematic of what the financial system is doing. Some banks have been more assertive and moving forward. I would argue we're one of those banks in changing for the new environment, but I think the whole system will eventually get there.
Okay. Former Fed Chairmans Bernanke and Greenspan, they were very strong advocates of, obviously, the free market, the invisible hand, and sort of that laissez-faire attitude perhaps have resulted in some lapses in financial stability that we saw. Do you think right now in this hyper-connected world of ours that sort of maybe too much of a laissez-faire attitude is a little bit dangerous?
Well, I think we've clearly moved to a more invasive is the wrong word, but clearly a more regulated world where it's not left up just to market forces. I think what the Federal Reserve has done, whose responsibility is safety and soundness, is to ensure institutions are primarily safe, but also that they're economically sound, that their business models make sense. So we're in a world where I think there's much more integration between the political regulatory world and the banking system as we get back to a safe and sound financial system.
After over 5 years of unconventional monetary policy, the U.S. Federal Reserve dried up the taps on its quantitative easing program in October of 2014. Since 2008, the Fed kicked off 3 rounds of QE, injecting trillions of dollars of liquidity to support the U.S. economy. Designed to lower interest rates, boost the money supply, and increase lending, quantitative easing was controversial from the get-go. The massive easing program caused a boon for equities, pushing the U.S. stock market to record high after record high. But many analysts questioned the efficacy of QE in supporting the real economy. Wage growth has been subpar, underutilized labor remains high, and the recovery has been one of the longest since the Great Depression. Okay, QE. QE is done?
Yes.
On a scale of 1 to 10, how effective was the Fed's QE for the real economy in the U.S.?
It's very hard to say because there are many moving parts, but clearly it was effective. I don't want to put a number on it, but I think it was very positive. It's not by chance that it's been mimicked in other parts of the world, and it's not an accident that it took so long for the regulators to decide to wean the country off QE. But it was necessary to stimulate economic growth. And look at the results. If you look at the simple report card, the U.S. is growing at 3+%, and will continue to grow at that for the next foreseeable future. For the world's largest economy to be back in a growth phase again is very good news for everybody.
Even for 2015, you think the U.S. will continue to grow at a very strong pace, given the weakness that we're seeing in Europe right now and the moderating growth in China?
I do. I think, firstly, the moderating growth in China is a well-broadcast reality, and it's moderating percentage growth, but off a very, very large base. China is now the second largest economy in the world, as you know, and will at some point be the largest economy in the world. So growing at 7+%, which it is at the moment, is actually phenomenal. It may not be on a percentage basis what it was historically, but in absolute terms, it's phenomenal. No, I think the U.S. will continue to grow. I think the U.S. has restructured the banking system. There are many reasons we can go into why I think it will continue to grow strongly, but I do believe it will.
The Fed's balance sheet obviously very bloated now with $4 trillion plus of treasuries. Do you think the Fed has a credible plan, or do you feel confident the Fed can unwind this balance sheet in a relatively stable manner that won't affect the credit markets that much?
Well, you'd have to ask the Federal Reserve, but I think they've handled a historic set of challenges through the financial crisis and since very well. And the evidence is the economy is growing, as I said. So they're very competent. I have a lot of confidence in Chair Yellen. The Federal Reserve governors are very talented people, very dedicated. And I believe with the economy growing that they will figure out a way to unwind this balance sheet and bring it back to a more normal state.
Has the Fed perhaps sort of sown the next seeds of another asset bubble with QE 1, 2, and 3 in terms of raising asset prices?
No, but I think that's a great question, because that gets at the heart of the ultimate juggling question between raising interest rates, which potentially has a negative shock on the economy, versus keeping them at historic lows, which potentially creates an asset bubble. And I think increasingly we're going to see in the minutes of the FOMC discussions about the balance between potential economic shock from raising rates to potential asset bubble from not raising rates. And at some point, those lines will cross and rates will rise.
Okay. I want to talk about the U.S.'s long-term outlook and growth. Do you think Washington has maybe a coherent long-term message for the U.S. economy, say for the next 5 or 10 years? Do you feel that as a Wall Street CEO?
No, I don't think there's a coherent message, because the political sector has not been able to cooperate on some very basic decisions like deficit reduction. Addressing some of the entitlements programs, like infrastructure build around the country. So there are a lot of ongoing challenges in the U.S. against this relatively positive backdrop I've given you. And we need a more constructive environment from both political parties and the administration to meet those challenges. We need a consensus view to be emerging. And I'm hopeful, but I don't know, but I'm hopeful after a very long time of a very polarized political sector that we will move back to the center and have a more consensus view.
Let's talk about global growth in general. Where do you want Morgan Stanley to be positioned in terms of for future growth? Where are the opportunities around the world you feel the most exciting? And if that does involve China, let's leave that for a sec, because we're going to talk about China later. So ex-China, where do you want to be?
Well, we go where our client needs are. If you go ahead of your client needs, then that can end in tears. As I said, we've gone from 12 employees in China to over 1,000 employees in China. So we have clearly rebalanced in this part of the world.
What has sort of the China experience been like for you? What are sort of the major takeaways from Morgan Stanley here?
Well, it's firstly, you have to have a very long-term view in any developing economy, which for many years China was an emerging market. I don't consider it an emerging market anymore. It's obviously an enormous economy. You have to be prepared to put people on the ground and to invest, which we did. We made some very good decisions early on through our investment in Ping An Insurance, helping with CCB to establish CICC, developing local leadership on the ground. Madam Wei Sun Christensen is now our head of China and co-head of Asia. Very strong local leadership. All of these are ingredients to building a long-term presence. But you have to step back and say, not what can you do in one particular year, but over a period of decades, how do we see our firm position? And a market of this importance and this size, it would be a tremendous mistake for a global financial institution like Morgan Stanley not to have invested. Thank goodness the people who came before me made those decisions, and now for the next 20-plus years we'll continue to grow on them.
So which businesses do you think have the best probability to succeed here in China?
Well, there are many parts. I mean, look at what just happened with the Shanghai Hong Kong Connect as an example. That's further opening up liberalization of the equity markets. Look at a lot of the state-owned enterprises that are seeking to do acquisitions around the world, are seeking to go public, are seeking to be market-based players. Clearly, if you're an investment bank that does that kind of business, that's an important opportunity for you. Look at the savers in this country who are looking to diversify their investments in various investment products. That's what we do through our wealth management business. Look at the various pension and other government agencies that are looking to have their assets managed. That's what we do through our asset management.
What about wealth management then here? Because at least right now for U.S. financial institutions, it's very difficult to have an onshore Chinese mainland wealth management arm. If we see financial regulations open up even further, is wealth management a definite play here on the mainland?
Oh, it's clearly an opportunity for us. I mean, it's half of what our company does. So we're good at it. We understand it. We create great product that individuals would want to invest in. So I see absolutely no reason why over time we couldn't be a stronger wealth management player, assuming all the licenses are in place.
What about the Shanghai Hong Kong Stock Connect? You were there actually at the opening in Shanghai at the Shanghai Stock Exchange, right? So what are your thoughts on that, and sort of how is Morgan Stanley involved in that?
Yeah, well, I was honored to be there. I was in China to celebrate our 20th anniversary, and it happened to coincide. Our anniversary, of course, was in Beijing, and this week the opening happened on the Shanghai Exchange. So I was delighted and honored to participate in that. I think it's a great sign. The world markets don't operate in isolation. They operate best when they're connected. So I think just the choice of language, Shanghai Hong Kong Connect, is a symbol of China's recognition of the importance to be a part of the global ecosystem as it relates to global markets. Very positive step.
All right, let's talk about Japan. Morgan Stanley's been in Japan for 4 decades plus, I believe now, so you've definitely seen the ups and downs of Japan and its economy. And recently, of course, Japan once again entering into recession. What are your general thoughts on Abenomics and the BOJ, and where the Japanese economy stand right now?
Well, you have to start off with the fundamental issues in Japan, and the most important issue is demographics. There's population shrinkage. It's a country of 120 million people that might eventually go to 80 million people or less. It's also a very aging population. So Japanese corporations, in order to find opportunity, need to take their capability outside of Japan to new markets, number one. Number two, the Japanese economy needs to be deregulated and liberalized, whether it's the healthcare sector, the agricultural sector. What they've done through Abenomics and through the third arrow and the various quivers of the third arrow is really what's important, which is driving fundamental structural change to the Japanese economic system.
But is the third arrow proceeding at a fast enough pace? Are these structural reforms actually being implemented? Is action actually taken on the third arrow?
I think there's some action taken. I mean, if you've been to Tokyo recently, you would notice, or other parts of Japan, economic activity is clearly picking up. Obviously, we've had 2 consecutive declines the last 2 quarters, but there was a strong period leading up to that. And some very painful decisions had to be taken, like the original sales tax increase. That's a dampener on the economy, but it was necessary for the revenue coffers for the government. So I don't judge what the government in Japan is doing harshly. I think they're being very courageous trying to shake it up. I think we all need to be a little patient.
As one of the 5 most prestigious U.S. investment banks on Wall Street before the financial crisis, Morgan Stanley was fiercely fighting for its survival following the fall of its peers Bear Stearns, Lehman Brothers, and Merrill Lynch. The firm faced down tremendous pressure from U.S. lawmakers to remain as an independent entity. To survive, the firm strengthened its capital base by converting from its traditional roots as an investment bank to a bank holding company. This allowed Morgan Stanley to access capital easier compared to its status as an investment bank. The firm learned a heavy lesson from the financial crisis and revamped its business strategy to make sure that what it went through in 2008 and 2009 doesn't happen again. An advocate of consistent returns, CEO James Gorman rebalanced the firm to seek more stable revenue streams. This shift put Morgan Stanley on a much more solid footing. Earnings in the third quarter of 2014 easily beat estimates and blew away the competition. DealBook even ranked James Gorman as Bank CEO of the Year in 2013. Let's talk about some of the softer sides of the business. Leadership. You've definitely turned the firm around since 2010, you and your team. Talk to us sort of about what you think about leadership. What is your perspective on leadership?
Well, the most important thing about leadership is to have a plan. A lot of people talk about leadership in terms of charisma. Can you attract a following?
You have to have that, though, also, right?
I think you do have to have the ability to attract a following, but they'll only follow you up a hill once. If you really want people to follow you, then, and true leaders are defined as followership, then you need to have a plan for them to follow. So we focus very early on having a very clear, simple plan that all employees could understand, could articulate, could remember, and could follow. If you then deliver against that plan, you build that followership in addition to whatever interpersonal skills you have. And part of the interpersonal skills are going local, are going and spending time with your employees.
But with so many people in the firm, how do you sort of motivate, get everybody on the same page and say, this is where we're going to be 5, 10 years down the road? You know, you can have the best strategy in the world. It's absolutely about execution and implementation, right?
Well, as they say, when you give a good speech, you get up and tell them what you're going to say, then you say it, then you tell them what you just told them. And it's repetition. We have a tremendous management team. We meet our top 250 executives every year, and we lay out very clearly for that group what it is we expect from the organization. They then go out to all parts of the world, all of our locations around the globe, in the 40 countries in which we operate, over 1,000 locations we operate, and populate that message. So we're constantly communicating. But again, the communication can't just be do better. It can't be admonishment. It has to be positive, but it has to be positive with a plan.
What about talent? Something that you're a very strong advocate of. Obviously, talent, Morgan Stanley is a talent business. How do you attract the best talent to Morgan Stanley? Not just intellectually, but I would guess the best fit for the firm as well. And then maybe the harder part, retaining them, because it seems like these days everybody stays at a firm for 1, 2, 3 years and then perhaps jump ship. So how do you make sure that people stay here and grow with the firm?
Well, it's a good question. There are a lot of, in a very fast-growing economy with lots of changes, young talent always want to look at where the next best opportunity is. But what we promise is a career where you're working with very strong professionals on very complex and fast-moving problems relating to the market. So that's pretty exciting. We received over 100,000 resumes last year, so we were able to attract the talent.
All right, finally, before we let you go, if you were able to have a conversation today in 2014 with John Pierpont Morgan and Harold Stanley, what would you ask them? What would you say to them?
Mr. Morgan, Mr. Stanley, I'd say thank you. Thank you for the courage of starting something which has now lasted for 78 years. Thank you for the wisdom to know what was true as part of our culture and what is not. And thank you for the shoulders in which I'm now standing.
All right. And on that note, thank you, James Gorman, Chairman and CEO of Morgan Stanley.
Thank you, Michael.
Thank you for joining us.
Appreciate it.